Hey traders, welcome to Charts and Coffee. Happy Tuesday, everybody. I know it feels like a Monday, but in fact, we've got this shortened week with non-farm payroll coming up on Friday. So it shan't be a boring one. Let's take a look at what's going on the calendar aside from non-farm payroll. Of course, we have the Labor Day bank holiday. So we're kicking off the week here on Tuesday. And at 10 a.m., we have the ISM number. Now, inflation metrics, the way that, say, earlier in the year, I would be really, we all looked at them so closely to look at what the Federal Reserve would ultimately glean from that and decide when they were going to start cutting rates. I don't find that the inflation numbers are as big a deal right now as consumer sentiment, retail sales, home sales, and jobs numbers. So with the rate cuts, we're going to get our first rate cut in 15 days. With that starting, as long as inflation doesn't heat up, the cooler inflation is sort of already assumed because the Federal Reserve is going to embark on what will be a multi-month, quarter point per meeting, at least that's what's expected, journey. So now we're shifting what we will be focusing on just a little bit. So these numbers were huge. We'll see if that number is still a high impact one. It's still a red hot zone, so we want to keep an eye on it. It's really numbers like the Bank of Canada on Wednesday, JOLTS on Wednesday, getting down into Thursday's ADP and non-farm. Again, I may or may not find that ISM services is a big impact, but come Friday, things will get very, very busy. We've got not only two Fed members speaking, one directly after, and then one a couple hours later from non-farm, Williams and Waller, but we've got the unemployment numbers coming out. So NFP, non-farm payroll, the unemployment rate, the average hourly earnings. Friday is going to be a big day. And what I'm finding now is the retail picture, the home sales picture, the employment picture, when they are less than expected, it is actually still mildly bullish to the environment, to the market sentiment. Now, in this environment, it's going to be tricky when you're looking at the hot zones because it was so easy to say bad news was good news for the last 8 months. Now it's not as much that the case. So just expect volatility, but the reaction is going to be a little different now that we're embarking on the rate cuts. Just a quick heads up there. So just know the time, know we're going to get volatility, but the direction might be a little wonky until we figure out exactly how these things are being reacted to. All right, back on over to the charts. Where are we to kick off the session? And as always, if you have any questions, feel free to type them in. All right, so where are we to kick off the session? Let's open up this 5-minute chart just a little bit. And the first thing that I want to know, and we've got it listed right here on the chart, the first thing and the easiest thing, and one thing I think everyone can do to determine an early market sentiment is where is price action in relation to the previous session close. So we've got that on the chart as a label and both as an automated percentage, price, and line. But the fact of the matter is, as long as you can put 4 p.m. cash close line on your chart, you'll be fine. So make sure it's a 4 p.m. East Coast time and just put a line right there. And that's your previous session close. Okay, that's your PSC. If you ever hear me refer to that, that's what I'm talking about. And we're below that today. Now, how far below? Pretty well. And this is actually really good. For those of you, my Sector Secrets Mastery folks, you're going to look at this and say, yes, we have potentially a nice short setup that's setting up cleanly because we've got our previous session close and it's at least on the upper end of our resistance zone of the hourly price movement range. So this is great. This is what we want to see in terms of structure, where I can be buying, for example, long puts or getting short the ES, maybe getting long puts in the SPY, SPX, ES options. We definitely are going to look at a cleaner setup there. Let's do the same thing on the NAS. So not quite as in the upper part of the range, but still I've got my previous session close, hourly price movement range, which means if I rally into that zone, the idea is to be able to set up a bearish play. However it is you like to set up a bearish play. I mean, for some traders, they might think, hey, Rog, can we set up a bearish play from the standpoint of, and actually now we're starting to get our new zones. Can I set up a bearish play from the standpoint of, can I sell calls as it rallies up to this area? For sure. That's if you want to sell premium. For me, I want to focus on the way most traders are going to have to focus on. I say most, out there, if you're listening to me right now and you've got an account under 25,000, right? That's not where you're always going to be, right? That's not always, but for right now, we trade what the reality is. And if it's under 25,000, I cannot emphasize enough. We really want to focus on a cash account where we have the flexibility of long calls and long puts. And I say flexibility because this way you don't have to worry about the number of trades that you're putting on. Because remember, when we have sub 25,000, we have pattern day trading rule. Who wants that in their life? That's what causes a lot of traders to have to cherry pick. Well, I'll take this trade, but I can't take that trade. And, Murphy's Law applies because it seems like if there's 5 trades to be taken, you take 3 of them, 2 of those are going to be losers. It just seems that way sometimes. And part of that is that limitation of playing spreads in a smaller account where you have the pattern day trading rule. The other part of that is, what is the typical cost of the option you're trading, right? So in order to have an approach that can grow an account when I'm looking at something like the Dow, is that always going to be realistic with YM futures? Maybe not. Is that going to be realistic with maybe micro YM futures? Probably a little bit more realistic. What about DIA puts and calls? Absolutely. And then when you understand what's in the DIA, you start looking at some of the related sectors and you realize, oh, there might be opportunity in any one of these sectors and the stocks within them. And how many of those have a reasonable cost? That's the hierarchy. That's the process of account growth, whether that be small account growth, medium-sized account growth, or Godzilla-sized account growth. What is the cost? And then for larger accounts, it becomes, what is the open interest? What is the OI? What is the liquidity? Because, some traders might grab 2 contracts. Other traders might want to grab 22 contracts, right? And a lot of that's going to boil down to cost and open interest. And these are basic metrics of account growth. These are the basic metrics and some of the hurdles that traders have when they're trying to grow an account. One of the most important ones is just being able to afford and take the trades. And that's why we focus so much on the style that we do in the Sector Secrets Mastery. By the way, if you want to learn more about that, on the 5th, I've got a class coming up, which means in the preceding weeks, I think it's the 24th of this month, which is right about 3 weeks away. I mean, it's going to be here before we know it. On the 24th and on the 2nd, I'll be with you to share a lot of the metrics of account growth. And, ultimately, the plan is to do what? Grow an account. That's it. Not hit home runs, not have debilitating losses. So when you look at something like this, this is just one view of what we did in the Sector Secrets Mastery. This was I believe it was 18.5 to start off. So not a tiny account, but not a giant account either. And and this was really about 2 weeks of trading, because we know the second week of August really is kind of the end of August, because the next 2 weeks are the lowest volume that we see anytime during the year. So when I look at this and say this was maybe 2.5 weeks of trading, I'm pretty happy with the way that it went. And that's still a good number of trades to have been in. Yeah, that's a pretty good number of trades to have been in a fairly short period of time. So those are the kinds of things that I'll share with you all. What are those metrics to account growth, and how are we doing in the mastery, right? Where's the rubber meeting the road? All right. So one of the things that as we go into September, we're going to expect is a resumption of the volume. Obviously, it's a shorter week, a lot more to pack into 4 days, especially considering we've got Bank of Canada and non-farm on Friday. And then if we step back and take a look at where we are right now in terms of, 3 things: where we were before that yen crisis, the carry trade unwind, where we were after, right? how much we've resumed, and to where we've been able to rally to. And you'll see there's a resistance zone right in here with the automated Darvis. And that's pretty much, right? These are the resistance levels before all that sell-off. So we basically come back to that area. And now decisions have to be made as far as how much higher am I willing to drive the Dow? How much higher am I willing to drive the S&P? That's kind of this collective question. Do we want to be buyers up in this area? What's going to be the catalyst for it? So you can see there's that zone, sell-off, recovery, and then where we sit right now. So yeah, if you're thinking, Rod, I'm not going to sit here and tell you I know where the market is going to be, S&P, Dow, NASDAQ, treasuries, gold, or otherwise 3-4 months from now. Oh gosh, no. If someone said, Rod, tell me which way you think it's ever going to move, I'd say we're probably going to wander higher. However, the most important thing is that doesn't help us as a trader, right? I mean, how many times have you heard about, what the Federal Reserve is going to do or not going to do, and inverted yield curves and recessions, stagflation, all this other garbage? At the end of the day, you and I are taking trades from maybe today to maybe 2 to 10 days. Those things just don't matter, right? They just really don't matter. So now I'm going to say, if you're struggling with what to do as we reach what could be an inflection point, shorten the time frame, right? That's why in the mastery we focus on, I'd say 3, but actually 4 time frames. Today is the first Tuesday of the month, as you all know. And that means that when I look at the day, it's kind of cool. It's probably one of my favorite days. We're going to start the day off with day trading, looking at a 5-minute time frame. Then we're going to move on to 1 hour and daily time frame for either a short-term or long-term swing. So overnight exposure, but still a fairly small, less than usually 2-week window of expectation of follow through the life cycle of the trade. All right, the last thing we're going to do today, and it's what we do every first Tuesday of the month, we're going to take care of our longer term portfolio positions. We're going to look at what we've got in things like McDonald's or Pepsi. We're going to look at things like what we got in Mondelez. We've been in a lot of these positions for a very long time, and some of them we just built in the last few months. And we look at those every first Tuesday of the month. So today, I get to wear all the hats that we're all capable of wearing as traders: my short-term sort of day trading, my swing trades, and then my portfolio. And that's really where we want to be as traders, where we're not locked into a symbol, an A style, and a single time frame, because that's where we really start to have a lot of opportunity cost by, that level of specialization. All right. Let's see. And all of those, by the way, the swing trading, the day trading, those are all cash accounts, gang. So at the end of the week, if I put on 5 trades, if I put on 15 trades between day trading and swing, it's no problem. All right. We optimize for that scalability, which is an affordable option that has lots of liquidity, and it opens the door to not just smaller accounts growing, but larger accounts, right, growing as well. All right. Questions. Let's see. I'm looking for some questions. I don't know if the Labor Day is still going on or not. Labor Day sale at Simpler. But you can come check out what we're doing over at sectorsecrets.com. Really easy to find. Let's take a look at what's going on with bonds and with gold this morning. But wow, holy cow. Okay, bonds woke up. Wowza. We had a long position in TLT that we bought on a dip. And yeah, so we'll see where, wow. So when I look at this TLT, when I look at this ZB trade, I'll just give you an idea of what we've been looking at. TLT, we bought the 97 calls. We scaled out once, and then we had to close this thing. So we're going to have to look at another entry. But I love that it's waking up. I needed to do this. I needed to do this on Friday, but that's okay. I love that it's starting to wake up. Yeah, my mastery folks are thinking, Rog, we're on the right path. Yeah, no doubt. Just about a day too late. And that happens. I love talking about misses and losses with you all, because gosh, you know what I find? I don't know, but you find this as well. Traders who do lose a lot never talk about it. Why would they? Right? We don't lose a lot. I mean, case in point, I love talking about losses because A, we don't have lots of them, They are there though, of course. Um, but if you don't learn to lose well, what's the opposite of losing well, by the way? Adding to a position, rolling the position, max debit, right? All these things are not going to map to when you step out to 20 trades, 50 trades, 100 trades. Those are typically not going to map to account growth. It's going to map to some really good trades that send your account higher, and then some really bad trades that take it all back and back and forth and back and forth. It's any number. It's any reason why traders just don't get sent some Dramamine as soon as they open an account with their brokerage, because unfortunately that's what they're doing. We want things much smoother. We want things much, much less volatile and chaotic and gradual. That's the one thing traders don't necessarily always want to accept, that a lot of times account growth is a gradual process, right? Now it can start to gain steam. I mean, think about compounding, right? It goes slow until it goes exponential. And that's not that similar, not that dissimilar to what it is we have to embrace in terms of a mindset as traders. As far as gold this morning, bonds are taking off. Gold's really not participating. I'm looking at my other screen, sorry. Not really participating, but if gold can give us another opportunity to get long, as well as GDX and Newmont mining, I'm game. And by the way, when we're thinking about relative outperforming sectors, yes, financials and healthcare have made some big strides at the end of August, which disproportionately benefits the Dow and the S&P, by the way. But the staples, the gold miners, utilities are still up in that top part of the sector performance. And that's why we'll continue to focus on some long positions in utilities. By the way, this is a fairly old trend, right? To talk about utilities now is just to kind of get to the party late. These are things we've been talking about since July, because staples, the defensives, have been stronger as July was winding down. They were strong all through August. So to talk about them now is to talk about them a little bit long in the tooth, but we should still see some good follow through as long as we can wait for the dips and take advantage of relative outperformers. Like, I know I keep talking about Coke, but this is what trading really is. It's, can I look at Coke instead of NVIDIA, even though everybody wants to talk about NVIDIA? That's an opportunity cost, right? Focusing on NVIDIA, which is just a heavily weighted stock, nothing more, nothing less. Don't make it out to be something it's not. But if you focus on those types of non-trending environments, you're going to miss things like, some of the utilities. Here's Duke, here's Dominion, here's Nextera. Pepsi is taking the scenic route, but there's Pepsi, Coke. I haven't been really keen on Walmart. I'll keep an eye on Procter & Gamble, although it's pretty ugly. Walmart's, it's kind of waking up. So there's a lot of places in the staples that would make sense to focus on as well. So let's keep that in mind as we go through the beginning of September. We're at sort of this crossroads in terms of, will the indices go higher? But here's the thing. If you're focusing solely on the indices, you're going to miss out. Just lift the hood on the Dow, lift the hood on the S&P, and you'll see financials and healthcare have really made a lot of strides. So maybe, focus on some of those sectors and relative outperforming stocks, at least for a few days, until the S&P, the NASDAQ, the Dow, and even the Russell decide, what it is that we really want to do next. We'll start to see maybe after non-farm and going into next week. But there are a lot of financials, gang, that are absolutely looking fantastic. And again, focusing on tech, having a disproportionate concern for the Magnificent Seven, is going to have opportunity cost consequences when trades like JP Morgan or Coke or financials, healthcare are going to be missed, right? Okay, gang, I will see you all tomorrow, same time, same station. And until then, heads up, gang, we have that 10 a.m. hot zone. Let's see how inflation data is going to affect September fall trading season. Until then.